Welcome to KP Data Investing channel, focusing on finding the best investment opportunities on stocks. In our previous videos, we shared the complete thesis in our holding of Foot Locker and Medifist. We classified them into two different types of company. Foot Locker is more like a value turnaround play for us, that the market is not valuing the company in the way that matches its historical valuation metrics. While Medifist is a value growth play stock that continues to show their growth in the past and in the future with fantastic valuation metrics right now, such as P/E ratio. Their return on capital and return on equity are just demonstrating that they are the top player. Barely anyone can find similar numbers in other companies, not even the tech stocks. Links to the full thesis can be found in the description. And here today, we are to do a video on getting an overview of which mega stock in the S&P 500 is the most undervalued. We do not have any stake in these companies, but we think that it is worth our time to know it because we might want to balance our portfolio a little bit by including some of these big name stocks in this downtrend. We don't believe in the strategy that putting everything we have earned in one single type of stock exposure. Let's say speculative stocks that we have seen massive downtrend in the past couple months. We don't think we need to give out names because there are just too many of them. Or putting all our money just in the dividend stocks that are barely been able to keep up with the inflation. If you are investing, we bet most of us are looking to have wealth appreciation with reduced investment risks. Before getting started, remember to press subscribe and like button if you think our research and due diligence is thorough and meticulous. Without further ado, let's dive right in. As we all know that S&P 500 is market capitalization weighted, which gives a higher percentage allocation to companies with the largest market cap. Let's take a look at the top 10 S&P 500 stocks by index weight. We have Apple, Microsoft, Amazon, Alphabet, which is Google, Tesla, Berkshire Hathaway, Nvidia, United Health Group, and Johnson & Johnson. Do any of you notice something that stands out to us right away? Yes, where is Meta, which we mostly call them Facebook? They are now on the 11th. Their stock price plummeted massively after announcing their financial report for fiscal 2021. We are not here to discuss why they had the hundreds of billions wipe out ever since. But surely, the stock price has reflected that investors are uncertain with their future on metaverse, which still needs time to prove the concept and, most importantly, how they can monetize from it. We just think it is noteworthy. So now, how do we find which mega stock is the most undervalued? This time we will use the analyst estimates posted on Yahoo Finance relative to the current market price action to calculate which stock is the most undervalued. Let's get on to our first mega company, Apple. They just unveiled the iPhone SE, the 5th generation iPad Air, the M1 Ultra processor, and other products on March 9th. Remember back in those days when we will wait every year just to find out the new products coming out from Apple. All the lines and waiting for get one in our hand. The innovation they had is just phenomenal. Their market price closed at $150 yesterday, with the analysts posting their estimate at $193. This means that the analysts think that they will have a roughly 28% upside. Next one up here is Microsoft. Their cloud computing service is growing rapidly and sharing the majority of the market share with the leader, Amazon's AWS. The business moat they have is quite obviously, as most people use their services, such as Microsoft Windows and Microsoft Office. Their closing price was $276, with analysts estimate their target price to be at $370. This indicates a 34% upside potential. The third one we got is Amazon. They just recently announced a stock split and $10 billion buyback. We all should be aware that the share buyback only worth a tiny part of their market cap. Even though it is $10 billion that can buy out many small cap companies just by cash, It is less than 1% of their market cap. The headline is their decision for splitting up stocks. It is the first split since 1999 and the fourth since their IPO in 1997. The stock just ran up a few percent right after they announced the news. The closing price for Amazon is $2,837 and the analyst's estimate is at $4,098, which implies a 44% potential upside. The fourth we got is Alphabet. They have two trading ticker symbols, which are GOOGL and GOOG. They represent two different share classes. The first one is Class A shares, in which the shareholders have one vote per share, while the one without an L is Class C shares that do not have any voting rights. In this video, we will take Class A shares, the GOOGL, for our calculation. Their share prices do not make huge difference. The closing price for Google was $2,534 and the one-year target estimate is $3,463. The potential upside is about 36%. Next one is the famous Tesla. Most people would have known this stock because they 20x their stock price in 2020. We surely don't have to illustrate how unique this company is and how innovative their work to the people. The achievement on electric vehicle by Elon Musk. Whenever people think about getting an electric vehicle, we bet most of you must have Tesla on the top of the list. Also, if they succeed in the business idea of robot taxi and autonomous driving, they will once again catch everyone's attention. Some might say their current market price is a bubble. But we think that it all comes down to the likelihood of Tesla reaching the growth expectation that the market has given to them. They closed at $766 yesterday, with a positive 25% upside to reach the analyst's target price of $959. The sixth stock is Berkshire Hathaway. All investors or traders should have known this stock. The American multinational conglomerate holding company by the most famous long-term investor, Warren Buffett. They have been outperforming the S&P 500 for the past decades. But some say that the performance has been lacking behind for the past 10 years because they did not get into the tech growth stocks. What we would want to say is that even they did not get into the high-growth tech stocks, they still remain to be performing close or beating the index. Their largest holding is Apple. We could see that their performance will be predominantly influenced by the market action of Apple. Their closing price was $329 yesterday, and the analysts expected a target of $345. This implies very little to 5% upside potential for Berkshire for this year. Next one we got Nvidia. The application of semiconductors is an essential component of electronic devices, such as communications, computing, healthcare, military systems, transportation, clean energy, and countless other applications. This is basically the heart of a human being for any electronic devices. Their stock price has climbed significantly in the past year, especially under the global supply chain shortage. The higher cost for getting the semiconductors has been hurting manufacturers. The closing price of Nvidia was $213, and the one-year target price is estimated to be at $341, which implies a close to 60% upside potential. Healthcare cost has rocketed significantly for the people living in the United States. And United Health Group is the American multinational healthcare and insurance company. They offer healthcare products and insurance services. They have millions of medical members, and their technology and care delivery through data analysis has been helping people to get a better and healthier lives. The stock price of United Health Group closed at $487 with the analyst's estimate of $527. The potential upside for United Health Group is around 8%. The last one we have on the list is Johnson & Johnson. We bet many people must have used their products at least once in their lifetime, such as baby oil, lotion, shampoo, Band-Aid, or Tylenol. They have dominated in the skin care, consumer health, pharmaceutical, and consumer goods. The products that they have in the market is just very diversified to every aspect of our healthcare. As a great example in the healthcare sector, they just have enjoyed a terrific economic moat that nobody else can beat them in the current market. The market price they closed yesterday was $171. The target price for Johnson & Johnson is $186, which has a close to 9% upside potential. Reviewing the top 10 mega stocks in the S&P 500, we can conclude that Nvidia has the highest upside potential based on the analysts' estimates posted on Yahoo Finance. Of course, we should say that those are just estimates, and this is only an overview for us. Those estimated numbers will change accordingly, depending on the economic environment and many obstacles that we have been reading on news, such as decade-high inflation, the heartbreaking incident happening in Europe, and the decisions of the Fed this year. The one-year price targets are just for reference only. All investors should do their due diligence before making any investment moves. Under these circumstances, we think that it is not appropriate to go all in into the stock market right now. The approach we usually take is to calculate the fair reasonable value for a company that we like and interested in, and only averaging in the stocks when the market price has fallen below our fair value. This is not the same as dollar cost averaging because DCA involves the approach of buying in the stocks no matter what. But our approach is more structured by only getting in when we find values in those stocks. It is our duty to protect our capital. If you have interested in our work, perhaps you can also watch our videos on some undervalued small cap stocks. We have shared our full thesis here today. Thank you for watching. Press the like and subscribe button, hit the notification bell if this video is useful. You will be notified when our latest video is uploaded to the channel. Leave your comments below if there are any thoughts on our work. We hope to continue sharing our findings in the stock market. Investing is for everyone. I will see you in the next video.